Hello, and welcome to Virtual Investor Conferences. My name is Matt Lateplo, and on behalf of OTC Markets, we're very pleased you have joined us for our next live presentation from Data Communications Management Corp. Please note, you can submit questions for the presenter in the box to the left of the slides. You can also view a company's availability for one-on-one meetings through the Schedule Meetings tab found on the conference platform. At this point, I'm very pleased to welcome James Lorimer, Chief Financial Officer, and Richard Kellum, President and CEO of the OTCQX Best 50 company, Data Communications Management Corp., which trades on the OTCQX Best Market under the symbol DCMDF and on the TSX under the symbol DCM. Welcome, James and Richard.
Thank you, and good afternoon, everybody, and good morning for those joining from the West Coast, and maybe good evening for any international folks that are joining the call today. I'm Richard, and sitting beside me here is James, and we're going to have to sort of flip the camera back and forth a little bit here, but I'm going to get James to start us off on the presentation today on the forward-looking statement information disclosure. James?
Thanks, Richard. Just wanted to remind viewers that we will be referring to forward-looking statements today. The disclosure is covered off on this cover page and is more fully described in our public reporting documents, which are filed on the OTCQX and on SEDAR+ here in Canada.
Okay, and as I said, good afternoon. Really excited to take all the viewers through the DCM story. I'm sure we've got people online that know our story, and we'll get into a little bit more detail. So first of all, about DCM, or Data Communication Management. We're Canada's second largest print marketing and communications company. If you look at this next slide, we really work at the enterprise level. So we really don't do any small or medium-sized organizational work. It's really at the enterprise level. We like to say the more complex a client, the more value we can bring to that client. We like to say that we eat complexity for breakfast, right? So simplifying complexity is kind of at the heart of everything we do from a communication perspective. We serve over 400 enterprise clients. Those 400 enterprise clients would represent roughly 94% of our revenue. Lots of diversification across the client base from a vertical perspective. We work in the financial vertical, we work in the retail vertical, we work in the transportation vertical, the lotto vertical, the automotive vertical, the QSR vertical, the not-for-profit vertical. So a lot of vertical diversification and a lot of client diversification. There's not a single client that's more than 6% of our total revenue. So, which is great, positions us well from a diversity perspective. And I'll get into a little bit more details in terms of what we do with these or do for these clients. But think of marketing, communication, and logistics and workflow optimization across a large, diverse client base. The market here in Canada is a sizable market for the services we provide. It's around a $10 billion market, depending on what data you look at. Some will say it's declining 1 or 2%. Some will say it's growing, 1 or 2 or 3%, depending what data you look at. We are roughly a 5% share of a $10 billion market, so just over $500 million in revenue. $500 million in revenue. So lots of opportunities for us to continue to grow in this marketplace and grow strategically in this marketplace, which I'll talk about in a few minutes. The trends of the market are quite favorable from a mix perspective and from a perspective in terms of what the value we bring. There's a lot of hyper-personalization happening in the marketplace. So think of highly personalized direct mail or even kind of highly personalized retail experiences. There's a lot of increasingly complex workflow opportunities. So clients trying to do more with less and really understanding how to optimize that workflow, which we do well here at DCM. There's been a move, and I'm sure you've experienced this in other industries as well, to outsourcing non-core functions, certainly in multiple verticals, but the FI vertical in particular, a lot of kind of outsourcing that obviously plays well to what we do here at DCM. Big, kind of focus on data metrics and performance analytics, and hence why we play well at the enterprise level. They want to make sure they're getting a return on the investments that they're making, so a lot of data to support that. There's a big move in the market for MarTech, or marketing technology solutions, to help with either workflow or optimize marketing communication, and we play to that space. And then finally, there's consolidation that's certainly happening in the industry as well, which we'll talk a little bit about as we get through the presentation. So a good market, a very good market, sizable market, and a good market, and it plays well to what we deliver. We've been on a 3-year journey. So I joined DCM almost exactly 3 years ago, and we've been on a journey to build both a bigger and very importantly, a better business. From a revenue perspective, our revenue when I joined was $235 million. By the end of 2022, we were $274 million in revenue, and that was all through organic growth. Okay, so there were no acquisitions between 21 and 2022. We actually grew 16% organically in 2022, and that organic growth, as well as building a better business, which you'll see in a couple slides, positioned us well for a sizable transaction, sizable acquisition that we did April 25th of 2023, so almost exactly a year ago. And a year ago, we acquired our largest competitor in the marketplace, known as R. Donnelley Canada, but trades under Moore Canada Corp. And that almost doubled our revenue from a pro forma basis. So again, largest competitor in the marketplace, which we acquired, and took us from that $273 million to reported $447 million. But remember, we didn't have the first quarter of that transaction in our revenue. So pro forma puts us around $540 million in revenue. Okay. We have been in terms of legacy DCM, and obviously now with the acquired company, have been relentlessly focused on improving gross profit. You can see the gross profit improvements that we've made, over the course of the last few years, and I got a little bit more detail on that in a minute. And then driving EBITDA performance as well. You can see that our numbers of $53.4 million in 2023 in adjusted EBITDA. So good solid growth, building a bigger business. And I want to talk to you about what's next now that we've acquired Moore Canada Corp, our largest competitor here in the Canadian marketplace, and been working on the integration of that business over the last year. First is on the what's next journey is our objective to return to 30% gross margin. For anybody viewing this slide, if you look at the dark blue line on the top, that was the gross margin for DCM legacy pre-acquisition, and the gray line on the bottom was the gross margin for MCC legacy pre-acquisition. And what you'll notice is the gross margin is very different, the gross margin profile. And on the DCM line, you can see that we were up in the 30 to 32% range, and we actually put a 5-year strategy plan to the street where we saw a path to between 35 and 40, and we were well onto that path. We acquired a business that had considerably lower margins. That was what was frankly quite attractive from an acquisition perspective. And we're in the process right now of moving fast forward to get that margin back to 30. What does that mean from post-acquisition? You can see the average on the quarters when we came together. Obviously, that 30% and 20% averages down to kind of the mid-20s. But we're relentlessly focused on improving gross margin, and that'll be a combination of the operational improvements that we will deliver. We'll talk that in a couple of minutes. the mix that we will deliver, and then through what we call strategic revenue management. Okay, so think of kind of price and mix. The other thing we've been focused on is really significantly reducing debt, and you can see that post close, our net debt was 125 million. We're down just around 40% since this deal was transacted a year ago. So very good progress in terms of debt repayment, down to just under 86 million. And our goal and our plan is to get down to below 1 times debt to EBITDA, and we're certainly on a good glide path to get there over the course of the next year or two. Okay, so great progress on net reduction and deleveraging quickly. We're also very focused on what we call productivity improvements or revenue per associate improvements, and you can see the chart on the right. A few years ago, we were around $225,000 in revenue per associate. We were committed to cross the $300,000 revenue per associate metric. We crossed that in 2022. And you can see that we're $302,000 per associate in revenue, 1,787 associates. So up considerably, especially over the kind of 5 or 6 year time horizon. And we're committed to see that number continue to expand with the integration work that we are doing. The next area I want to talk about, which I've kind of referenced, is the synergies or the post-merger integration synergies that we will deliver. When we first announced the deal, we announced that we saw a path to 25 to 30 million in synergies. We then refined that target to deliver 30 to 35 million in annualized synergies. On a run rate, on a full year run rate. We will be closing on the operational side. We'll be closing 4 facilities. We've already closed 1, 3 more to close. Lots of opportunities on organizational alignment. We've already delivered a lot of organizational improvements. You know, we don't need 2 of each department. Good progress on pure procurement, and obviously some mix and revenue synergies as well. So kind of 4 areas that we will deliver that $30 to $35 million in synergies. We're very well planned. We were working with Boston Consulting Group to help us on pre-merger and post-merger integration. We're very well planned to be able to deliver these synergies over the course of the next year. Okay, so good progress and good momentum. Our priorities for 2024, one is obviously the integration of Moore Canada Corp. As I already mentioned, the plant consolidations that need to be complete, the harmonization of our back office and our systems. I already referenced our relentless focus on improving gross margin. That'll be through strategic revenue management opportunities, kind of driving lower overheads and improving the operating costs. We are investing in some new capital which will improve our OPEX, and then continued efficiencies. The third, obviously, is growing our business. So expanding our product offerings and services, upselling, cross-selling current clients, penetrating new clients. We've got a very strategic approach to the marketplace, and then accelerating our digital portfolio as well. And then our fourth priority for the year is to generate higher levels of free cash flow, and that, again, will come through margin improvement, and then a prudent focus on capital allocation. So some clear priorities for 2024. And I'd say the main priority is to get the integration work complete as we continue to drive growth in the marketplace. A few investment highlights before I turn it over to James to look at our capitalization and ownership. Again, we're the leading, and we have a leading position in the Canadian marketplace. It is a great market here in Canada. We know where all the high margin profit pools are and how to play successfully into those. We've been very focused on profitable growth, so not growth at any expense. So again, knowing where those high margin pools are and tuning our commercial model and our capital model to win in those pools. We're committed to driving the operational efficiencies that we've identified, and we'll continue to be relentlessly focused on securing those. We do have a great track record of debt reduction and free cash flow generation. We've proven that over the last number of years. And we've got a great, highly experienced leadership team with a lot of acquisition and integration experience. Myself, I've been involved in several deals and had to integrate with excellence across several large deals. So I think we're a well-oiled machine to be able to deliver against this sizable acquisition, and the integration excellence will deliver against it. I'm going to turn over to James now for a quick look at our capitalization and ownership.
Thanks, Richard. Our market cap currently is about $180 million Canadian. Recent share price is just a little bit over $3. I guess about a year ago when we announced the Moore Canada acquisition, our stock was around the $1.40, $1.50 range, and so we had quite a significant appreciation in our stock following the acquisition. We have about 60 million fully diluted shares outstanding, and very strong insider ownership. Directors and officers own just shy of 30%. We have an employee share purchase plan. We've had very good take up on that. A little over 2.5% of our group or of our shares are held by employees, and that would be outside of any officers that are participating in the employee plan. We have a large independent shareholder that's been with us for many years, a private company called KST Industries. And then, broad range of retail and institutional shareholders. When we did we did an equity offering, private placement financing after the acquisition, and we attracted a number of high caliber Canadian small cap institutional investors. So we've got a very good long-standing mix of shareholders in our company.
Okay, thank you, James. So I'm going to close on that and move into Q&A. We are, maybe to summarize, as I said, largest, we play in the marketing, communication, and execution space here in Canada, one of the largest providers in the market, work at the enterprise level, acquired our largest competitor, working on continuing to build both a better business and a bigger business, and we see a strong market and strong opportunities. Okay, over to Q&A, and there's a question here. I think we've already answered it, but I'm going to repeat it. What are the drivers of your productivity gains, and do you have 2024 targets for cost saving synergies post-acquisition? So as I said in my presentation, we've identified $30 to $35 million in synergies from this acquisition, and we've got detailed plans to deliver against those 30 to 35 million. And the plans are in operations, as I said, closing 4 facilities or integrating 4 facilities. Will be moved from 14 plants to 10. Organization synergies and procurement synergies. Those are what I call kind of hard synergies. That's what adds to the 30 to 35 million. The one thing we didn't talk, or I didn't talk, is the cost of achieving those synergies. Shareholders that have been following our story saw that we booked $21 million in synergy one-time expenses in 2023. And so when we announce the closure of a factory or of a plant, we need to book the synergy. So majority of those were booked in 2023. We'll have roughly between $4 and $5 million in synergy expenses that we'll be booking in 2024. So to deliver best way to think about it, deliver $30 to $35 million of synergies, our total cost will be in the kind of 24 to 25 million range. So below 1-to-1, which certainly from my experience and many deals that I've been involved with is a great delivery. Okay. There's a question here. I'm going to turn it to James because you referenced it briefly. KST Industries is listed as just under a 10% shareholder. What is the relationship with DCM and KST?
KST has been a long-standing shareholder. I think they first probably invested in the company back in 2013, 2014. And we're consistently in the kind of 11 to 12% range. When we did the equity financing, they did fall slightly below the 10% threshold. And KST is a family investment fund, has been a very supportive shareholder over many years.
Okay, thank you, James. I'll go back to the Q&A list here. Okay, with 5% market share, which company is taking or losing share? Great question. So we are the second largest company in Canada. The largest company would be a company called Transcontinental, who also trades on the Toronto Stock Exchange. And their business, there's some similarity in their business, yet there's some differences. They're big into the packaging business and have acquired many packaging companies over the years, which in an area we don't play in. But they would certainly be the largest competitor in the marketplace, next to obviously the company we acquired, which was Moore Canada Corp, or Ardently Canada. When you get below that, you move to companies that are considerably smaller. Certainly they are competitors in the marketplace. But we have quite a unique position given we're very much focused on that enterprise level. We don't service the small and medium-sized businesses at all. So very difficult to say who's taking and losing share. We grew 16% organically in 2022. And that was a combination of price, mix, and true revenue. So, winning new business. We won about $35 million in new business back in 2022. We actually won about 70 plus new logos in 2023 as well. So certainly we're seeing some share opportunities in the marketplace. So hopefully that answers that question. I've got another question here that is, do you have any research coverage? Yes, we do. We've got two firms here in Canada that cover us. A company called Acumen and a company called Claris. And we also have some paid research from a company called eResearch, who does an excellent job in writing us up and understanding our business model. So yes, we do have some coverage, and we're looking to expand that coverage, of course, over time as well. All right, there's a question here. Current estimates show no revenue growth for quarter one. 2024 estimates of 139 for quarter four, estimate of 141. Why? Let me understand that. Current estimates show no revenue growth for quarter one, 2024. Well, there's two ways to look at that. One is we will actually have revenue growth for quarter one, 2024, because we didn't have the acquired company in that quarter last year. Okay? So if the question is, will we show revenue growth? Certainly, we've got a business that we acquired at the start of Q2, and that revenue will be in our quarter one revenue this year. And then, of course, on our earnings call, we'll talk about what the underlying will look like. Okay? Is that fair to say, James? I got another question here question around sequential revenue growth. Will we show sequential revenue growth? And I think that's a really good question from one of the people attending. Look, here's what I'd say. The market is very good. We put a number to the street about a year and a half or 2 years ago, a 5-year target, which said we see an opportunity for 5% compound annual growth. And then shortly after we put that target to the street, we grew 16% in year one, and we were roughly 10% at the end of quarter one, 2023, before acquisition. So we certainly know how to win and how to grow in the market. As I said, we see it as a strong market. We're still very committed to the 5% CAGR over 5 years. What I'd say is it likely won't be linear. Never is when you acquire a company of the similar size. and our focus is to build a better business. So strategic revenue management and margin enhancement is a real focus area for us. So we're still committed to the 5% CAGR over 5 years. And we'll see how that kind of unfolds quarter by quarter, but nothing's ever linear, especially post digesting a sizable acquisition of this nature. Okay, but we see a good market. We've got a fantastic commercial team. We've been able to select the A team from the two companies, and we see lots of opportunities for continued acceleration in the marketplace as we work through the strategic revenue management process as well. Okay. Yeah, I think that's the end of the Q&A here. So from calendar, okay, sequential. Do we see so? I think there's a build on the question here. Sequential revenue growth from calendar Q1 to calendar Q4. Yeah, that's another good question that we'll tell you a little bit more about as we get into the quarters. Not every quarter. There's the business we acquired has some seasonality because of tax season and transactional mail. So not every quarter will be equal. But certainly as we look at sort of communicating our growth, we'll be clear in terms of the growth we're delivering relative to perform our underlying growth. Of course, that's going to be all clear when we start overlapping next year. So maybe a long way of answering your question. I can give you more clarity when we get into an earnings call about how the year will look quarter by quarter. But we certainly expect to see positive 5-year that 5-year commit, that 5-year CAGR we're still very committed to. Okay, so that's I think the end of the Q&A here. Unless there's anything else, I think we're pretty much on time. So thank you for the opportunity to present the DCM story today. And James and I, you've got our numbers on this final slide, are here to answer any questions that you may have.